Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more content like this, please visit adisa.org and check out the resource library. My name is Greg Mausz. I'm your host today, and I'm joined by Jeffrey Slotterback. He's the CFO of WhiteHawk Energy. Thank you for being here.
Thanks, Greg. It's great.
So let's lay a foundation here. Bring us up to speed. What's going on right now in the oil and gas markets?
So I think we've seen this real move to quality. There's been an industry-wide focus on core basins, core operators, and that starts with the public companies and makes it all the way through our space. I think the other thing that's been so helpful since the downturn of that 2015, 2016 timeframe has been real discipline by the operators, again, public companies all the way through, real discipline on how much capital they're deploying and making sure that that capital is generating cash flow returns for investors.
Good. Discipline, right approach. You know, the oil and natural gas have experienced a lot of boom and busts, so it's nice to have that discipline. Let's talk about some of the drivers of natural gas and oil these days.
Well, it's important to remember they're two very different commodities, right? Oil is much more of a global marketplace. Gas is a little bit more US based, although we've seen a tremendous growth in how much natural gas we're exporting. Mm-hmm. So right now we're exporting about 13% of what we produce on a daily basis. It's going to double by the end of the decade. There's about $35 billion in infrastructure projects that are coming online starting next year and then again in 27, 28 to take advantage of a very wide spread between U.S. natural gas and European natural gas.
And these are those export facilities, right?
That's right. And what's amazing is those facilities, 90% of the gas that will flow out of those new facilities has already been sold. In fact, those facilities are underwritten by sales contracts 15 years from the start of the facility, from commissioning. Those purchasers in Europe are locking in and buying those, and that's what allows those operators and those developers to finance the projects.
And natural gas is very flexible in that it's used for fuel, it's used for heating, but it's also used for power generation. We were here at a panel yesterday, and one of the takeaways there was every time we create a new use of power, we just add it to what's already being used.
Yes.
Nothing really gets replaced. There's just huge demand drivers for electricity, and natural gas is a great fuel source for that. Can you expand more on some of the need for electricity and how natural gas can play a role there?
So in the year 2000, gas was about 16% of what we, was the source for about 16% of what we generate for electricity. It's now around 45%. And that's been a shift over the last 25 years. It's also a reason why the U.S. carbon emissions are the lowest per capita they've been in decades, because gas burns so much cleaner than coal. That's really what we've displaced.
Fantastic trends.
But over that time, you haven't really seen a significant growth in power demand. It's really been a shift from coal to natural gas. We're now seeing incredible demand drivers, particularly on the AI, the cloud computing. All of those resources are huge draws of power. Think about these data facilities, 100 megawatt, 300 megawatt, even up to a full gigawatt power draw. It's an incredible demand for natural gas. We even just heard that Microsoft, I guess, is restarting 3 Mile Island, which is a crazy story to me. We'll, I think, see some more nuclear, but none of those facilities are really have the opportunity to be operational until next decade. Mm-hmm. Gas we have over 500,000 miles of interstate pipelines, intrastate pipelines. There's another 2 million miles of distribution pipelines. So much easier to get gas to market. We've been very blessed as a country to have incredible reserves and resources, and just seeing that be really this bridge fuel to power this wave of coming technology. We see it too with electric vehicles. Every time I watch a football game, all I see is a commercial for a new electric vehicle. Those vehicles need to be charged. 3 of the Tesla superchargers use as much power as a 50-unit apartment building. So it's coming in many forms, but it's a very exciting story.
The other thing that I'm observing is there's multiple companies working on robots now, including Elon Musk has a robot company. But I mean, obviously powered by all these battery packs and stuff like that.
Yeah.
And they're trying to replace some, I guess, routine, mundane tasks and freeing up people to do other things. But it dawned on me that the robots are taking power, and whatever the humans do next is probably going to be using power as well. So, I mean, there's no stopping the demand for electricity.
It's just coming. We call it the electrification of everything, right? And I think there's a real disconnect a lot of times for people that those devices are using electricity, right? Just because it's a battery, people, I think, forget that needs to be recharged, and that takes significant electricity usage.
Okay, I want to shift the conversation a little bit to politics. How are politics playing a role in both the prices, but then also the development of oil and gas reserves?
So, I mean, I think we are not the political football that at other times it may have been. I think in part, you see this wave of electricity coming, and I think that's so important for the country. It would be hard-pressed for somebody to try and get in the way of that. Our historical experience is really seeing kind of a little bit more regulation, higher cost inputs leading to higher prices in left-leaning administrations. On the flip side, we see production and drilling increases from Republican administrations. For me, I'm on the royalty side, so not having those cost drivers. In either scenario, we feel really excited about what's to come. I think both candidates, right, the number one thing people are trying to do is maintain and lower inflation. I don't think anybody's really incentivized at the moment to add levers or metrics that would make our fuel prices, our home heating prices, those things go up in price.
So we've been laying out some points here on why natural gas. And so here at the ADISA community, we're talking to financial advisors. So is there anything else that we should cover on why investors should be focused on investing in natural gas?
Well, I think it's an amazing time in gas, right? Natural gas trades on a NYMEX exchange, right? Futures contracts going out years. And so right now you have, unlike oil, you have a situation where the price today is in the high $2 range, but those futures prices rise to $3.50 very quickly. Mm-hmm. Whereas oil is actually a backward dated curve right now. You're investing at low 70s and it's declining. The strip price is declining to mid 60s. So it's a very nice dynamic, especially when you're more of a cash flow vehicle like a minerals company. I can effectively buy at today's price and then hedge and lock in and secure that rising price in the future.
Understood. So that's kind of why natural gas. Now, as investors, they can invest in public oil and gas companies. They can do MLP investments. But, you know, there's also drilling funds out there. There's working interest funds, and there's royalties that investors can also participate in. Can you touch on all three of those really quickly?
So the drilling funds are really a tax strategy, right? If you're a high W-2 earner, great way to defer income, take a significant write-off, all of the intangible drilling costs, basically anything on the well that can't be picked up and moved to another site, is a deduction in year one. So that's a great strategy for those. I think what you're limited by there, and on the working interest side, which I'll touch on, is you're in a much more confined set of wells, right? There's a pool of capital raised. It goes to a specific set of wells where those are drilled and then brought online. Working interest, non-op, you're participating in somebody else's operation. So a little bit more capital intensive. You don't have as much control, but you have the ability to partner with and leverage great operators. And that's a really interesting strategy as well. On the royalty side, it's pure cash flow. I don't have any capital expenditures. I don't have any lease operating expenses. So my cash flow margin can be 90%, even in downtime, lower price environments, because I'm always generating that free cash flow. It's the operators that are fueling and investing all of that capital to continue to drill. And so we're still generating cash flow even with new wells that come online.
Great. Thank you for laying out all three of those points. Speaking specifically about royalties, are there any tax advantages associated with those?
So you do get the depletion deduction. So in most years, you will be able to take some form of your 1099 income, and that'll come as return of capital and be tax deferred.
Okay, that's helpful. Anything else you want to tell the audience about oil and gas investing?
I think it's a very exciting time. What we do as a country, as an industry now, is amazing. Recently saw EQT, which is the largest natural gas company in the country, has drilled 20,000-foot lateral wells. So
Wow.
think they're drilling a mile deep and then bending the hole and drilling horizontally over 4 miles.
Unbelievable.
It's incredible. What a country.
Thank you for taking the time to give us these latest updates. Great points about the politics and the demand drivers with this tech boom that we have going on. So really appreciate it.
Thank you, Greg. It was a pleasure.
And thank you for watching another episode of Focus on Alternatives. Again, for more information like this, please visit adisa.org. Thank you.